Gautam Trivedi joins us now. Let's connect with him. Let's understand what he makes of the current market setup. Good morning. Are you ready? Can I ask you a question?
Yes, I'm absolutely ready. I'm always ready for you, Nikunj.
That's very kind of you. We always look forward for this interaction. So thank you for joining us. It's been a good year. If you bought stocks in April, May, June, or even July.
Correct.
So the summer rally of 2023, do you think it will extend itself for remaining part of the year?
I think it will. And let's understand one very basic thing, which I think sometimes people, when I meet them socially, they think India is the only country in the world that seems to be having a stock market rally, and all the money in the world seems to be only coming here. Because if you read the financial newspapers or media channels, you almost get the feeling that we're alone in the world. But this is a global rally. Let's understand that. Year to date, the total amount in terms of market cap expansion of the world has gone up by $6 trillion. You've got the DAX, you've got the CAC, you've got the Nikkei at all-time highs, the Nifty 50, of course, all-time highs. These are real events that are happening across the world. So in spite of all of the war in the Ukraine, the price of oil, Saudi Arabia trying to keep the price of oil up, all of that has nothing to do with liquidity. Liquidity seems to be coming unabated, and I think that's what's really driving the markets right
now. So let's understand the global setup. Inflation is coming back. It could be tomato and onion, but it is corn, wheat, maize, and US residential prices, at least for the developed market. If the narrative changes, which is that from no more rate hike to one more coming, could that really act like a sledgehammer for the global setup, and could things really backfire?
I don't think so. Sledgehammer itself, you need something more significant than that to really impact global equity markets. So I don't think one more rate hike is really going to be the death knell. Now, the question really is, and I got this WhatsApp only this morning, and I assume it's mostly true, that the absolute amount of debt within the US systems, whether it's student loans, credit cards, auto loans, housing loans, etc., are at record highs. Now, does the US have the ability to actually service all of this debt? And will that additional 25 or 50 basis points rate hike by the Fed tip the scale towards a full-blown recession? I don't think so as yet.
Okay. If I look at your current portfolio construct, it's centered around banks. And a lot of banks, HDFC Bank, Axis Bank, IDFC Bank, ICICI Bank. The numbers are somewhat mixed for some of the banks. PSU banks have reported a drop in NIMs, whereas private banks, they continue to chug along smartly. What is in store for banks now?
So if you're right about that. If you look at the private sector banks on an aggregate basis, you've seen NII growth of about 27%. Again, this is for the first quarter results. You've seen a PPOP growth of as much as 34% and a 38% growth in PAT. So numbers have been spectacular. But going forward from here, I guess the one concern that we have is that NIMs have, I think, for the time being, peaked. Credit growth also, to some extent, has started to moderate from around 18 to 20% to about 14 to 15%. So I think from these levels, you will see probably moderate gains in the banks. Having said that, the bigger issue that I find within the banking sector, especially the corporate lending book, is the fact that no matter which company I meet, every promoter seems to be having only one agenda. How soon can I get to net debt zero? Or in some cases, net cash. So there seems to be a huge aversion to debt. And that this obviously began pre-COVID when the entire NPL problem blew up in our face. And since then, a week doesn't go by when I meet a promoter who says, I want to be debt-free as soon as possible. So that is a concern from a corporate lending book.
Gautam, hi, morning firstly. We were just discussing in the morning as to what then is the core portfolio strategy. Be lazy, that's going to work out best. Don't try and venture into leverage trades.
Yeah, I think, I don't know. I don't think leverage is such a bad thing, first of all. So, when these promoters say that, and I say, little leverage is only good for you. It's good for your ROE. But I guess I think the impression they seem to have is that lower the debt, better perception from an investor's perspective, and a better market cap. So that's at least the way they seem to be, I think, thinking about it. But from a portfolio construct standpoint, I think if you look at the results so far, the sectors that are doing well are B2B, B2G for sure. You've seen what's happened with defense and railways. And then the premium and luxury segments, whether it's cars, hotels, air travel. If you look at the hotel industry, for example, June RevPAR was up 27% over pre-COVID levels. Ethos, look at that. What a great story that is. Revenues up 10%, PAT up 40%, same-store sales growth 23%. So there are pockets of India that are actually doing very well and seem quite disconnected with things like the rural slowdown, which seems to be making some sort of a comeback. But I'm just saying, there are pockets in India that are completely disconnected with what you see in terms of a slowdown in the rest of the economy.
Gautam, you've been a big votary of urban consumption, and you bought into stocks like Landmark. You bought into stocks like Varun Beverages. You bought into stocks like Sapphire Foods.
Yeah.
Where are some of these urban consumption stocks headed? Because A, it's a niche pocket. B, there's a base effect which would kick in.
Yes, I agree. But if you look at, let's say, Sapphire Foods, or even a Landmark for that matter, and both in some sense are similar because both have branch expansions taking place, whether it's adding more restaurants for Sapphire, Kentucky Fried Chicken, or Pizza Hut, or for Landmark, geographically moving to other parts of India because they are focused on the West. They have Delhi, they have Punjab, and then they have a agency of Mercedes in Kolkata and Madhya Pradesh. So I think while you may not see necessarily a big SSG growth for both of these businesses, you will see revenue and top line and progressively EBITDA growth because the absolute number of branches will keep expanding.
Investing right now, apart from buying car companies, watch companies, pizza companies, I think Eureka Forbes has made it up there. So now you're playing the full chain, right? First, bet on water, clean water. That's what all of us need. Clean water, simple.
And with clean homes.
I know. I'll tell you, your point on Eureka is interesting, but I'll tell you why we bought it in the first place. Because we're, as you know, our ethos of, no pun intended, but ethos of buying the companies is that we try and see if the company has a trigger that's embedded in and that hasn't played out as yet and will play out over the next 3 to 4 years. So specific to Eureka Forbes, I think, which is a classic example, a company that wasn't doing too well under the previous management, taken over by Advent, which has a history of turning around companies, Crompton Greaves Electricals being a case in point. And basically had brought in, one of the best CEOs in the country, Pratik Pota, who did wonders with Jubilant Foodworks. So that, I think, is a great turnaround story, which will play out over the next 2 to 3 years. I'm not saying a quick fix to Eureka Forbes in 6 to 8 months. You will see that happening. So that's the reason we bought Eureka Forbes. But to answer your question, I think the other businesses that one needs to focus on, and again, these are newer businesses that have got listed in the past about 12 to 24 months. Wind, you're seeing more activity now in solar, and I mean, wind's really taking off. If you see the kind of tenders that are coming out and the government's own target of 10 gigawatts of annual tenders for the next several years, EMS companies, and if you look at the non-Amber and the non-Dixon, you're seeing a significant, growth in those companies. They have obviously higher EBITDA margins and very different and specialized products. I think smart meters, that's going to be a big business as well. And, we have one listed drone company. I'm sure more will follow.
So you've been very forthcoming with a lot of holdings in the portfolio, but I also wanted to get in a sense from you as to any sector or space you believe that is very overvalued in a market like this?
Good question, because the whole market's overvalued in some sense. But I think, well, we've erred in investing in IT a little too early. Probably now might be a good time to actually start building up smaller positions in IT. But, I think, I don't know, I'm struggling to answer that question because, I mean, a lot of stuff is out there is good, but expensive. And I think it's going to remain, unfortunately, expensive for a while. So I don't really have a better answer than that.
Right. Okay, Gautam. Short chat, but pretty cohesive in terms of the ideas and what your take is right now on the market. Good to have you on the show as always.
Thank you. Thank you.